Good evening, everybody. Uneducated Economist here. So I'd like to thank Jason S., who pointed out in my last video that I was inaccurate with my numbers and that a $400,000 loan with a negative 1% interest rate over 30 years is not $295,000, but is actually $342,000. And I thought about deleting the video, except that I looked at the comments and I thought, the questions, the points, the arguments, the discussion itself, that's still valid. Even though the numbers I gave were inaccurate, it's kind of inconsequential to the discussion, considering it was a hypothetical question to begin with. So thank you very much, Jason S., for pointing that out. Now we really do know what those numbers are. And I'm always going to bring you the best, most accurate information I can. And if I ever come across something where I know that I'm wrong, I'm going to be the first to come out and tell you guys, because I'm here to learn just as much as you guys are. And, I'm not going to pretend like it didn't happen. Thought I'd talk a little bit about mortgage-backed securities today. There was a great article that came out of Wall Street talking about the Federal Reserve's balance sheet and how these mortgage-backed securities have been coming off at a faster pace than even they were expecting or wanting them to. So these mortgage-backed securities, if you're not familiar with them, if you can imagine a box, and in this box is a bunch of loans. And these loans, as they get paid off, the investor gets, basically reaps the award of the interest payments that the mortgage-backed security pays. So these mortgage-backed securities, they've been a really sound investment in retirement funds and pension funds. These are were considered a class, a AAA rated asset to own. Now in 2008, these things went toxic where people weren't making their payments, and the Federal Reserve ended up buying a bunch of these mortgage-backed securities off the big banks, because the big banks were basically suffering with these toxic assets as people weren't making their payments, and they were, having troubles issuing out new loans as, if they have all these bad loans sitting on their banks, on their balance sheet already. So the Federal Reserve printed up a bunch of money and bought those mortgage-backed securities off these big banks and put them on their balance sheet. Well, as of lately, they've been trying to unload their balance sheet. And they've been unloading these mortgage-backed securities. Now, they've been trying to unload about $20 billion a month, but even more than that has been coming off. Interest rates have been very low, and as people are taking advantage of these refinancing at these lower interest rates, they're paying off that old loan and reestablishing a new one. When they do that, they are paying off that mortgage-backed security that the Federal Reserve has. So the Federal Reserve is unwinding at a faster pace than what they were anticipating these mortgage-backed securities to do. And they're taking that extra money and they're buying treasuries with it. So even though they are unwinding their balance sheet, the mortgage-backed securities themselves have been coming off faster than what they were anticipating, or what they were trying for, I should say. And now, if you can imagine, the other people who are selling mortgage-backed securities right now are the big banks. Because see, big banks really don't make a whole lot of money when interest rates are as low as they are by holding on to loans. They make money by selling mortgage-backed securities, by selling loans. So they'll gather up a bunch of loans, put them in a mortgage-backed security, and sell that off. Well, if interest rates begin to rise and refinancing gets to a slower pace than it is now, a much slower pace, the Federal Reserve may end up having to sell mortgage-backed securities as opposed to just allowing them to be rolling off the balance sheet like they are now. And if they ever get to a point where they're going to be selling them, they're going to be selling them against who? The big banks out there. And the big banks are going to be in competition with the Fed due to the fact that they won't really be able to hold on to these loans because they don't make a whole lot of money off the low interest rates. They make money off of selling these mortgage-backed securities. So they're going to be in trouble if this takes place. The only way to attract an investor is to start raising the rates on those loans to make the mortgage-backed security more attractive. At least that's what I see. Uneducated economist. You guys let me know.